wanted to do is just open up the profit and loss chart here for this married put. For those of you who were curious of what I was referring to about the limited risk, this is the profit and loss chart for this unique setup of the married put that we use. We typically buy puts that are in the money and at least 5 months out in time. So for example, here on the trade that I linked over for was Checkpoint Software. I could buy Checkpoint at 31.05 today. At the same time, I could buy the April 2010 35 put. That's about $3.95 in the money. It would cost me $4.90 for that put option. My total investment would be about, for 100 shares in one contract, it would be about $3,595. But remember, I purchased a 35 put, so between now and April expiration, I have the right to sell my shares of stock at 35 at any time. So I'm only risking $95 per share, or $95 total, should say 95 cents per share, or 2.6%. So here's our profit and loss chart, and the blue line here, the blue profit and loss chart, shows us this is the maximum loss that we could take. The maximum loss that we could hit is that $95, but we'd only hit that at expiration. If we did absolutely nothing, the blue line shows us at April expiration, if we did absolutely nothing and the stock was trading below 35, we'd have a loss of about $95. We still have an unlimited upside profit potential. But notice also here that this red line shows us the halfway point. So halfway between now and expiration, as if the stock moves up, we have a much lower break-even point. We can make a profit even if the stock just goes up to about $33 to $34 per share. So this is a unique way of trading, but we don't just sit there and leave the position alone. The methodology that Kurt uses, the radioactive trading methodology, that allows you to do is there are 10 different income methods we can essentially apply to this position. Let me take the pen to generate income and essentially move this profit and loss chart up. We're only risking 95 cents. So if I can do some different income methods over the next month or 2 months, move this position up, eventually I may end up with a married put profit and loss chart that looks something like this. So I still have unlimited upside profit potential here, but I can't lose because on the downside, because I've moved this up. Let's say I collected over $95 was our maximum risk. Let's say I collected $180 or generated $180 in income over the next couple of months. I now have what we call a bulletproof position where I can't lose on the downside, and I still have unlimited upside profit potential. And, potentially depending on the time frame and how the stock reacts, I could maybe end up bulletproofing the position, but still have 8 or 9 months to go in order to, before the put expires. So I can still generate a lot of income. Okay, let's see here. All right, Joseph has a good question. Mike, I'm unclear when you have a married put, that's what we're looking at right now, then you do a covered call. The graph shows at that point, what does it assume you get called out at? But you don't, and you get to sell another. So how does the graph look? Does the graph get adjusted every month? Well, Joseph, what we show you is let's just take this Checkpoint married put, and I'm going to go ahead and add a covered call position. Okay, we're in the custom spread tool. I linked to the profit and loss chart. Okay, what I'm going to do is I'm just going to add a November option to this position. Now we bought the 35 put. Typically, when I do income method number 1, what's called income method number 1, when I sell a call on the radioactive profit machine, I only want to sell a call that is at or above the put strike price. For this simple demonstration, I'm actually going to cheat. I'm going to select the November 32.5 call. We would never do this, but I'm going to do it just for the graphical demonstration. Once I click that option, it's going to fill into the third block. I'm going to change my action to sell. I'm going to take the married put position and act as though I'm selling a call against it. This will create essentially a collar position. And I'm just going to hit submit, and that's going to grab the natural bid price of 20 cents here. Okay? And this is typically what we would see with this type of collar. When I sell a call below the put strike price, I don't get a very rewarding profit and loss chart. Okay? Now, what's interesting about this position is when we started off with our Checkpoint Software position, the married put position's initial risk was only 2.6%. Well, now we've moved it up to 9.1%. How did we do that? I mean, we sold a call. We generated income even here on this graph, it looks like the most we could lose moved up from about 95 cents to 76 cents. It's the most we could lose. But that 9.1% risk actually happens on the upside. So if the stock takes off, we enter the position, we're bullish on the stock. If we sell a call below the put strike price and the stock starts to move up drastically, what's going to end up happening is we're going to have a loss on the upside. And the reason why is because even if the stock moves up very high, let's say it moves up to 35 or 37.5 per share, what's going to end up happening is we get called out at 32.5. That's the strike price of the call we sold. We get called out. We don't take any advantage of the further increase in the underlying stock price, and the put continues to lose value. Now, what we show you is we show you the standard position. You know, I'm looking at this graphical position of what I have right now. If I sold the call against it, what would my new profit and loss chart look like? I'm not speculating forward and saying, oh, if the stock ends at 32.5 and this expires, what's going to happen if I can sell a new call against it? Because we don't know where the stock's going to be, Joseph. We don't know what's going to happen next month. So it could be trading up at 37.5, and in that case, I might have to buy this call back, but I'm not going to sell the 32.5 again. I might sell at 37.5 or 40. Well, without using the Black-Scholes pricing model, I can't really estimate what that's going to look like. Of course, you can do the Black-Scholes pricing model right from this page. You can go, for example, to the option chain, and from the option chain, you could link to the Black-Scholes pricing model to estimate further out in time what a position might look like, what an option might look like if the stock was trading at a set price. We can do that for this position alone. Okay, I can go ahead and say, what would this position look like if the stock was trading at $35, let's say on 11/11, halfway between now and expiration, and it would give me the breakdown there on the profit and loss chart, but also down below, it'll show me how much the gain or loss I would have between the short call, the long put, and the long stock as well. The graph only gets adjusted every month if you make a new trade. Okay, we're just showing you the current trades. I'm not sure if I'm entirely understanding your question. We're just showing you what the position would look like now. We don't show you a graph of what the position looks like until you actually select to enter a new trade. So if I'm tracking a married put in the portfolio and I add a call to it, we're not showing you what the speculation would be if you just rolled the call for the next month yet until you decide to do that. Okay, Joseph, if I didn't answer your question, why don't you go? Let me know if I didn't answer your question all the way, because I'm not sure if I fully answered it the way you wanted me to. Okay. All right. Okay, Joseph, I'll wait to hear from you later then. Okay, Swing, this is a question that I've had come up several times. Let me clear this and redraw the chart here, okay? I'm going to explain this a couple ways. What are we looking at here? We're looking at a married put position. Okay, we're long the stock and we're long the put. Now, a lot of people will look at this and say, okay, well, wait a minute. This is simply just this looks like the same as a profit and loss chart for a long call. Okay, so instead of buying the stock and the put, what if I just bought a call? Wouldn't I have a similar risk reward? Well, the answer is yes, essentially. When you look at a long call position, a long call is a parity trade to a married put. And by parity, we mean they have the same risk reward chart when you first open the position, but they do not behave the same way. And there are several different ways that the long call can get you into trouble. One of which is that you can over leverage the position. Okay? For example, let's say I had $10,000 to invest, and right now, and I'm looking at Checkpoint. Well, if I saw this married put position, the total cost per 100 shares is about $3,500, $3,600 almost. If I had $10,000 to invest, the most I could do was 200 shares and 2 contracts. Let's plug that in, okay? We can do 200 shares and 2 contracts. Let's resubmit that and look at the numbers. The profit and loss chart is going to look very much the same. We're still going to have our hockey stick graph. Blade, as we like to say, Kurt and I like to say it, I'm a hockey fan, so the blade is on the ice. This is the correct position we want to be in. Unlimited upside profit potential on stocks we think are going to grow, and a very limited risk down on the downside. Okay? So now with the $10,000, we've invested $7,100, and we're risking a total of about